Wait a minute. Are we in a financial crisis? How did this even happen so fast? I mean, the stock market has already imploded. People are being laid off left and right. And this is despite the government's guarantees of worker wages and absolutely massive bailouts in private enterprises almost across every country on earth. And mind you, this is only within a month of the virus that is to be unnamed hitting the Western world. Okay, you might think, Mr. Sergeant, have you been living under a rock? No. I'm aware that all of this lockdown has huge impacts on the economy, especially on the travel industry, on tourism, restaurants. People want to stay inside. However, when we have a crisis, we have a tendency to look at the pin and blame the pin that bursts the bubble that we have created ourselves. What I'm trying to say is, are there underlying problems in our economy, or is this situation just going to fizzle out sooner rather than later? Now, some of the world's leaders are claiming that the economy is in its best shape ever.
Comes in the midst of just an unprecedented economy.
That we have delivered on our promises and exceeded our expectations.
Best economies in the history of our country.
And I know it's difficult to define what a healthy economy really is, given that a lot of economists disagree on this subject, but I will share with you a shockingly disturbing statistic for you to think about. Almost 2/3 of Americans in the United States are living paycheck to paycheck, meaning a lot of people would be having trouble coming up with $400 to pay off an unexpected bill. Now, you might be fooled into thinking, yeah, this is just people living in poverty. However, 18% of people making six figures, that is above $100,000 a year, are also living paycheck to paycheck. That is absolutely insane, and it is a telling sign about the culture of spending that we live in. So now you're thinking, yeah, okay, Sergeant, that's just the US. Europe is better at saving. And while that is true, remember that in 2019, 90% of the United States GDP was spending.
Consumption is typically 2/3 of the US economy. That's the way it's been year in and year out for a very long time. In 2019, consumption was 90% of the US economy.
A large portion of that spending is on imported goods from around the world. United States is in fact the world's biggest spender and debtor nation in the world. This means that the country you currently reside in can still be heavily impacted if your country is dependent upon exports to the United States. Imagine a European company which has 30% of their exports to the US. That company would most likely take a financial hit during a crisis in the US. Remember that the 2008 crisis was deemed a housing crisis in the United States only at first, before it became a financial crisis in the rest of the world. In the United States, more than 30 million people filed for unemployment since mid-March. China has almost 500,000 companies going bankrupt in the first quarter of this year, and many European companies are laying off their employees. And remember, this is just the beginning of the crisis. Okay, what's happening? Let's just take a step back for 1 second. Well, to understand the situation we've put ourselves in, we need to understand some key concepts of economics. First of which is the interest rate. What? The interest rate? That sounds incredibly boring and irrelevant. But trust me when I say that the interest rate is one of the most important instruments of the economy that there is. Yeah, so what about the interest rate? We all intuitively know what it is. It is a percentage that you pay the bank for having borrowed money right now. Economists usually refer to interest rate as the cost of money, because it is the price you pay for wanting to spend the money now rather than later. However, the most important thing about interest rates, though, is that they push up the valuations of pretty much anything you need lending for. And don't just take it from me. Warren Buffett, one of the most prominent investors, says that interest rates are like gravity and valuation. If interest rates are nothing, values can be almost infinite. If interest rates are extremely high, that's a huge gravitational pull on value. As a response to the 2008 financial crisis, the Federal Reserve, which is the Central Bank of America, and the European Central Bank have kept interest rates at all-time historic lows. This was done to encourage consumers and businesses to take out loans, because you're more likely to take out a loan if it's cheap to do so. Remember, if interest rates are low, that means that the price of money is low, which means that the valuation of things are going to go up. To demonstrate this thesis, let's look at a real-life example when you want to buy a house or an apartment. The bank will lend you money up until a certain point, and that point is usually based on how much money you have left over after your fixed costs each month. It has almost nothing to do with the size of the debt you're about to take on. This is extremely important, and we'll get back to this later, but it has nothing to do with the size of the debt you're about to take on, but your ability to pay back the debt with interest. So let's say your buffer each month has to be 2,000 bananas. The currency is not important. So you need to have at least 2,000 bananas after you've paid all of your costs. This is your buffer. Great, so how much can you borrow? Well, that heavily depends on the interest rate. So say you want to buy a house and your income is 10,000 each month. The interest rate is 2%, which leaves you with a max loan of 1.8 million bananas. How is this broken down? Well, 5,000 each month just to pay off the loan. And this is based off of a 30-year loan. 3,000 bananas go to the interest rate, which leaves you with exactly 2,000 bananas. Perfectly, that is exactly the breaking point of how much your buffer needs to be at a minimum. Now let's say you change the interest rate to a lower percentage. Let's just say it's 1%. This leaves you with a max loan of roughly 2.2 million. This is because you have 6,100 each month just to pay off the loan, and then 1,800 each month as interest, which again leaves you with 2,000 bananas, hitting that breaking point of the bank's lending standards. There is this invisible bar here between how much of your loan is interest rate and how much is paying down your loan. Let's just call it the interest rate bar. If the interest rate is higher and you're only able to pay off 4,000 bananas each month, well then you can at maximum borrow 1.44 million bananas. And this is the theory behind lower interest rates driving up evaluations of things. Unfortunately, the same goes for businesses, stocks, and other assets, so it's not much of a surprise that the housing market is again at an all-time high, given that the interest rates have been almost nothing for the past 8 years. Because the interest rates worldwide have been low for so long, it has increased the corporate debt in both the Eurozone and the US substantially since the crisis of 2008. Not only that, but another unintended consequence, or dare I even say intended consequence from the central banks, is that low interest rate disincentivize people and businesses to have any savings in the bank. In fact, now many banks want you to pay to store your money in your bank account. This leads businesses to spend almost all of their profits instead of having a small amount of money for a rainy day. In fact, that's what a lot of larger companies have done. They've done stock buybacks for billions of dollars and are now asking to be bailed out by the government, which ultimately translates into the taxpayer, which is essentially you and me. This creates a massive moral hazard because companies that spend their money recklessly and without risk are now being rewarded by not going bankrupt and potentially acting recklessly again in the future, much like the bailouts of Wall Street that happened during the crisis of 2008. So why is this recession going to be different than 2008? Well, for one, we started the last recession on a higher interest rate, and this is important because by lowering the interest rate, central banks prevented a lot of bankruptcies. How? By refinancing. Let's look at an example. If a company's income is 30,000 each month, 10,000 of which are fixed cost, 6,000 to pay back the loan, and 3,000 worth of interest, the company is left with 11,000 worth of profits. But when their income plummets to 18,000 due to negative market pressures, they're now unable to pay their bank loans. But when they went to almost 0% interest, a lot of businesses could afford to refinance their current loans and almost wipe their monthly interest rate payments. If you do the same today, because companies can borrow so much money, they're leaving themselves vulnerable because they're already not paying any interest rates. So there's not much room to lower, which will make them unable to pay back their monthly fees. And refinancing is not an option here. So you're thinking, all right, Mr. Sergeant, what do we do now that we already have low interest rates? Well, that's the second part of this video. A crazy thing that might happen is even lower interest rates. George Gammon, a brilliant market analyst, has this to say about it.
Well, the way their models work, and I've never seen them, but I would assume based on their actions, that if you have interest rates at zero, well, if the solution for a recession is to take interest rates from 4%, let's say down to zero, Well, then the solution, if you're already at zero, has got to be to take them to -4. Problem solved.
So you're probably thinking, Mr. Sargent, did you shave since the start of the video? And I sure did. But you're also thinking, can they really do that with the negative interest rates? And they sure can. But what's even more scarier than that is another economic instruments that the central banks have initiated. Have you ever heard about quantitative easing? No? What about large-scale asset purchase programs? I've probably not heard about that either. What about money printing? Yeah, that's right, because the two terms I just mentioned are basically synonyms for money printing. Now, it's not money printing like you're imagining that there's a physical printer printing money, but conceptually it's the same thing that's happening. It is creating new money and then pumping it into the economy. So how is this even done? The very short version is that central banks like the American Federal Reserve or the European Central Bank start buying bonds, which are essentially loans to either governments or corporations. But a key thing to remember is that whenever a central bank buys, well, anything, it does that with newly created money. It's not like they have an account that can go to zero like regular bank accounts you're familiar with. That is why it's important to keep an eye on the bank's balance sheet. Now, take a look at this. This is the Federal Reserve's balance sheet, which has been at a staggering $4.5 trillion for the past couple of years. But look at what happened between the 24th of February and the 27th of April. Their balance sheet went from $4.1 trillion to $6.6 trillion in the span of just 2 months. Again, it's important that I reiterate, when the Federal Reserve does this, it buys these assets with newly created money. They create money out of thin air, also referred to as helicopter money, which was first coined by the American economist Milton Friedman to explain how the central banks are just printing money without creating any value. And Europe isn't off the hook either, because the European Central Bank has launched their own asset purchase program, which is going to expand their balance sheet and create new euros to be spent in the economy. So why is this so scary? Well, if you could just print money without consequences, why didn't we do that a long time ago? The inevitable consequence is going to be inflation. When more money is in circulation and being spent in the economy without having created new goods or services, prices will go up. And the value of whatever currency is being printed will go down.
The amount of money in circulation increases. But there's a big problem, because after a while it means the worth of every note starts to fall, because more notes are chasing the same number of things to buy.
It is a basic economic principle of supply and demand. But that is for another video, which, by the way, if you want to see more of these videos, feel free to subscribe, like, comment whatever you feel about this video. But during this crisis, when a lot of governments are dishing out bailout money, they only have two options to fund it: debt, which is going to be paid back someday by taxpayers, or inflation, destroying how much you can purchase with the money you already have. It might not sound too scary, Mr. Sargent, you're just scaremongering, but remember how the interest rate being low has incentivized people to recklessly borrow and spend. What do you think is going to happen once people realize that their hard-earned savings are being eroded due to the banks printing the currency into oblivion? Even more spending and less saving for the next crisis. Indirectly, they're screwing over people who have saved up money and rewarding people with a lot of debt. Because if you have a lot of debt, you actually benefit from inflation. It makes it easier to pay back the loan. This really makes me think of a scene from Mr. Robot where the banker says,
"Give a man a gun and he can rob a bank. Or give a man a bank and he can rob the world."
I will leave you with this clip of a guy named Neil Kashkari, the president of the Federal Reserve Bank of Minneapolis. I'm not going to go into detail because I want you to think about what he's actually saying in this clip and ponder what the possible consequence of it is. Just think about how this is going to affect the economy. And as always, this has been the Command Sergeant Major General. Thank you for watching Private.
We are being very aggressive, and I think our chairman, Jay Powell, has learned from the experience of 2008. We're moving much faster than we moved in 2008.
Can you characterize everything that the Fed has done this past week as essentially flooding the system with money?
Yes, exactly.
And there's no end to your ability to do that?
There's no end to our ability to do that. There's no end to our ability to do that.